This is an Uncovered Japan Company research report on Tri Chemical Laboratories, ticker 4369. The company makes ultra-high purity precursor chemicals used to deposit atom-thin films inside advanced semiconductors. Its niche product breadth, sector-leading profitability, and Korean joint venture form a compelling quality story. But semiconductor cyclicality, capital spending, and a full valuation make the entry question more demanding. The report uses market data as of June 12, 2026, and is dated June 14. Forward earnings were valued at 24.8 times. Fiscal 2026 operating margin was 24.7%, return on equity was 16.3%, and the equity ratio was 76.5%. Those are strong quality markers, but the multiple stood roughly 40% above the selected sector average, while margin buying was unusually heavy. A precursor is the source molecule used in chemical vapor deposition and atomic layer deposition. These processes build the insulating, conducting, and protective films inside a chip. Tri Chemical has developed more than 2,000 compounds and specializes in small customized batches, purified to as much as 9 nines. Because tiny contamination can destroy wafer yield, customers qualify the material and production process together. That creates specification lock-in and long supplier relationships. Revenue more than doubled from 11.6 billion yen in fiscal 2022 to 23.9 billion in fiscal 2026, a 5-year compound growth rate of 19.4%. The path was not smooth. Revenue fell 18.5% in fiscal 2024, then surged as the semiconductor cycle recovered. Even through that trough, operating margin stayed near 17% before returning to the mid-20s. Investors should distinguish operating profit from net income. The core Japanese manufacturing business produced relatively resilient operating earnings, while the 50/50 SK Tri Chem joint venture serves Korea's large memory manufacturers. Because it is accounted for by the equity method, its profit appears below operating income and can make reported net income swing sharply. The report therefore treats operating profit as the cleaner measure of underlying execution. The balance sheet provides genuine resilience. The equity ratio stayed between roughly 77 and 87% over the displayed period, and fiscal 2026 return on equity was 16.3%. This matters in a cyclical semiconductor materials business, because it allows the company to fund capacity and research through downturns. It also means management should be judged on whether retained capital earns an adequate return. Operating cash flow remained positive, generally between 3 and 6 billion yen, but free cash flow fell to negative 3.3 billion in fiscal 2026 as investment in the Minami-Alps plant peaked. This is not automatically a warning if new capacity ramps as planned. It becomes a problem if utilization lags, depreciation arrives before demand, or customers delay qualifications. The plant ramp is therefore the most important operational milestone. Capital returns lag the operating quality. The payout ratio is around 20%, the dividend yield was near 1%, and there were no buybacks in the 5 years reviewed. Holding the dividend flat through the fiscal 2024 downturn is a positive, but the overall framework remains conservative relative to peers. Management has signaled a review from fiscal 2028, making a clearer return policy a potential re-rating lever rather than part of today's base case. The midterm plan targets 31.7 billion yen of revenue and an operating margin of 27.3% by fiscal 2029. The near term is deliberately harder. Fiscal 2027 revenue is guided higher, but profit is nearly flat as labor, depreciation, and running costs arrive before the Minami-Alps plant reaches scale. Generative AI, advanced logic, and increasingly complex 3D NAND support demand, but the ramp must prove itself. Tri Chemical's earnings multiple has moved violently with the semiconductor cycle, from roughly 11 to 36 times across the report's historical points. At 24.8 times forward earnings, the company was neither at the peak nor obviously cheap. The market already recognized high margins, structural growth, and balance sheet quality. That leaves less cushion if the cycle weakens, the new plant ramps slowly, or joint venture income disappoints. These are the report author's assumption tests, not price targets or investment advice. From the 3,515 yen reference price, the 3-year range runs from roughly 52% downside in the bear case to 69% upside in the bull case, while the base case sits near fair value. The spread reflects cyclicality, the Minami-Alps ramp, China and geopolitical exposure, Korean joint venture profits, and the possibility of better capital returns. To conclude, Tri Chemical is an unusually profitable niche supplier to advanced semiconductor manufacturing. Its purity, product breadth, customer qualifications, Korean partnership, and fortress balance sheet support a real moat. The trade-offs are equally clear. A cyclical end market, concentrated Asian exposure, temporarily negative free cash flow, conservative shareholder returns, and a valuation that already assumes quality. For the full evidence, assumptions, and source detail, continue with Uncovered Japan's free deep dives. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.